My background is very much focused on financial regulation. Over the past 25 years, I have focused very much on sort of the role of the financial sector in economic growth and development, both from a positive standpoint as well as a negative standpoint, which means that I spent a lot of time looking at financial regulatory frameworks from the standpoint of, one, how do we support the functioning of the financial sector, but also how do we prevent financial crises. I've been at Hong Kong U since 2000, so 19 years. I was in London before that. I moved to Hong Kong U because in the late 90s I was spending a lot of time going back and forth between London and Asia working on Asian financial crisis issues, in particular with Thailand, Indonesia, and South Korea. Hong Kong, coming out of the Asian financial crisis, as with much of the rest of East Asia, made it a real focus on improving their legal and financial regulatory systems. Really, the Asian financial crisis was the period of beginning to build Hong Kong's financial regulatory system. And Hong Kong University, at the same time, decided to build their research strength as well as teaching in this area, basically feeling that from the standpoint of supporting Hong Kong's future development as an international financial center, it was increasingly important to have people with financial law expertise, financial regulation expertise. And for bad or good, what has been the fastest growing area of financial sector employment over the past 20 years? Compliance. And so if we look at certainly the demand for students with law, regulation, compliance backgrounds in major financial centers, that's something that doesn't seem to be going away. Now, it's the beginning of a new year, beginning of a new decade. And I always like to start by thinking a little bit back. What was the last year? What was the last decade about before thinking forward a bit? And I think if I can get this a little bit the old-fashioned way. If we look at the 2010s in some ways were a funny sort of decade. It was really a decade that was in between something and something else. What was it in between? Well, one of the big themes, certainly for finance, of the 2010s was the global financial crisis. Pretty much the global financial crisis was a dominant theme for every aspect of global finance across the past decade. Flash for a book that we just published end of last year, looking at systemic risk in the financial sector 10 years after the global financial crisis. If we look at what was the other big theme from the standpoint of global finance, was this: technology. Technology was a dominant theme in the context of digital financial transformation. And I think if we look at this interaction between the aftermath of the global financial crisis combined with technology, one of the things that we see coming out of the confluence of the two is Fintech. A new way of thinking about technology in the financial sector, and also more recently, RegTech, the idea of using technology for compliance as well as regulatory purposes. So, if we're thinking about technology, over the past 10 years, I think we can say that we've seen digital financial transformation across four major areas. The first, the global financial system. And if we look at global financial system, I really highlight two examples where I think the impact of technology is more significant than anywhere else. The first, payments. If we look at global payments markets, if we look at SWIFT, if we look at BIS Forex figures, $6.5 trillion a day changing hands in Forex markets. About 400 billion of that each in Hong Kong and Singapore, the two major foreign currency trading markets in this region. Those transactions are almost entirely digital, very little in paper-based cash. The other area is very much securities trading. It's an interesting thing. Think about, anyone know, who are the largest traders, who are the largest market makers in US equity markets today? Thoughts? It is a bit of a trick question, actually, because if the answer was, many of you will think Goldman Sachs or Morgan Stanley, and 10 years ago, you'd be right. But today, two largest market makers in US equity markets, Virtu and Citadel, they make up 50% of daily transactions between them. They're on one side or the other, or both sides, of 50% of US equities turnover daily, and almost as much in European markets. What did Virtu and Citadel start out as? High-frequency quantitative hedge funds. Basically, they've evolved from essentially high-frequency quantitative-focused hedge funds to large-scale market makers. To the extent that today that when we are looking at transactions in major markets in the US or in Europe, the vast majority of transactions involve no direct trading between human beings. They are algorithms trading with other algorithms. That is digital financial transformation. In some ways, it raises an interesting philosophical question. Do we need humans for markets? Is it a market if you only have machines trading with other machines? Perhaps that's our ultimate expression of artificial intelligence, of AI. And of course, it's no coincidence that if we look at who are some of the biggest spenders on AI, it is traders, particularly hedge funds, but also large proprietary traders like Virtu and Citadel. Why? Because it's a constant arms race in the context of analytics. Who has the edge in terms of analytics? And increasingly that means use of ever more sophisticated forms of analytics, machine learning, and Bloomberg's estimate last year is we've got roughly 10 billion US dollars of effectively independent AI trading funds. Now, these are supervised by people, but basically the activity of those funds is largely independent. Why? Traders are testing. They're seeing, does it work? And as a result, when we think about the standpoint of global finance, digital transformation is basically done. That's a story that took a long period of time, but largely done. What's the second piece? The second piece is the exciting sort of fintech startup scene that I think has really dominated the headlines over the past 10 years. Lots of those discussions over the past 5 years or so have been about, will those startups disrupt traditional finance? The short answer, I think, we can now say, is probably not in most cases. What is the business model of most fintech startups? The business model of most fintech startups is a trade sale. It's build up your size to a sufficient level that you can sell your firm off to someone. Very few are actually targeting trying to compete, trying to disrupt markets, and I think that's interesting. What is also interesting is if I think 15 years ago, if I would run into a friend who had just left a global investment bank, what were they invariably doing? One of two things. They had either just opened a hedge fund or they had opened a restaurant. All investment bankers love restaurants. Today, if I run into a friend, and sometimes I hate making this joke because I'll immediately run into a friend of mine and they will say, my partner, my spouse, my brother just left an investment bank, and what have they done? They've started a fintech startup. And so I think it's been a pretty dramatic change. If I look back 15 years ago, most R&D in financial institutions was really about sales. Today, at least some element of R&D is actually about tech development as opposed to basically arbitraging different forms of products. So fintech startups, I think, an important trend. The third piece, though, is actually the one that from a positive standpoint, I think is the most important and the one where I spent the most time with Afi and a range of others. And that is a trend that we've seen in developing countries. If we look at developing countries, the possibility of leapfrogging traditional financial systems is something that we're seeing more and more frequently. Less in places like Hong Kong or Singapore or Malaysia, where the financial system works pretty well, more in places like China, India, and probably next, Indonesia, from the standpoint of places where the financial system doesn't work very well. And the fact that we are seeing technology used in a way to basically completely change the way that those financial systems work in a very short period of time. It's one of those things that if you're dealing with the Chinese financial system, or if you just go to China as a tourist today, the way the financial system works, the way the payment system works, is simply unimaginable from how it was 10 years ago. China, most recent announcement, not only shutting down all of the P2P lenders, but creating its own central bank digital currency. That's a pretty rapid transition in a pretty short period of time. And it's something that in this region, I think we're likely to see more of. Myanmar, a great candidate for leapfrogging. Why? You've got less than 3,000 ATMs across the country and an 85% smartphone penetration rate. Why do you need ATMs? Skip the whole thing. Move basically to a Chinese sort of Alipay system. Indonesia, moving. Vietnam, moving. A range of others, moving as well. That's the good bit. What is, in some ways, the risky bit? In some ways, the risky bit is the fourth piece, and that is what we think of as big tech, the involvement of large tech firms increasingly in the financial sector. And of course, I think we can take two examples of this where we've seen the most development, and for the positive side, really exciting. Think about Amazon in the US. Think about Alibaba's subsidiary, Ant Financial, in China. In both cases, these are the second largest SME lenders in the country. New research looking at both examples basically showing that this is new lending. It's not diverting existing lending from the traditional financial sector, but actually new lending entirely. And if we think about one of the biggest sorts of issues in development over the past 30, 40 years, it's been SME financing, constraints on SME financing. And to the extent that a platform data giant like Alibaba or Amazon can use their existing data frameworks to do, this is the interesting part, cash flow analysis of small businesses in order to make loans to support those businesses, the potential economic impact is huge. SMEs, cash flow-based lending never worked because it cost too much. Any firm that spent the time on cash flow-based lending, you'd want a larger client which could justify the costs of doing the analysis, but on the basis of large-scale data. And think about it for a second. How many firms run their entire business on eBay, Amazon, or Alibaba? They buy all of their inputs, they have a site, they sell all of their stuff. And this is even more so with Alibaba than Amazon, because with Alibaba, you can literally acquire everything, and you can then use Alipay to even pay your staff. What does that mean? It means that from the standpoint of data, Alibaba has a very complete picture of your costs and your income, and is able to basically look at patterns and determine not only a sort of score, which they use for all kinds of things, including like hotel bookings and potentially social credits and the like, but also to base cash flow lending decisions on. And that's really interesting. Now, it's kind of funny though, if we think about it. How do they fund it? Because after all, neither one is a bank, though they do both now have sort of subsidiary banking licenses. Generally, they borrow in the interbank markets to fund these loans. They then repackage the loans into asset-backed securities, which they then sell to institutional investors in the debt capital markets in their respective countries. And today, Amazon and Alibaba, or Ant as it happens, are amongst the largest issues of asset-backed securities in the US and China respectively, which as it happens are the world's two largest securitization markets. Talk about a transformation. China today being one of the world's largest securitization markets. At the time of the global financial crisis, it was basically illegal. That's a big transformation. So, big tech, that's the positive story. But there are also lots of questions in the context of the impact of big tech in the context of financial services going forward. And this last year was probably the biggest story that really highlighted those big tech questions. Libra. And in many ways, from a central banker's standpoint, you've got the world before Libra and the world after Libra. Why? Because Facebook's announcement that it was going to launch Libra, and what is Libra? Libra is a combination of three things. It's a cryptocurrency, a currency, a form of money, a means of payment, a medium of exchange, a store of value, with an electronic payment system, with a system of digital identification. That is meant to basically address issues of access to finance of people around the world. But what it immediately does for almost every country in the world is raises questions about sovereignty and control. In other words, what if a US tech company becomes the issuer of the world's money and runs the world's major payment system? This suddenly has concerns from pretty much everyone in the world, and the international political reaction from pretty much every country in the world has reflected that. And of course, if we think about Libra from the standpoint of the risks, one can think of from the standpoint of monetary sovereignty, one can think of cybersecurity issues, one can think of data security issues, data privacy issues, one can think of all sorts of different issues with this. And this is one reason why it's being taken very, very slowly. Just as an aside, what do I think is really the underlying rationale for Facebook to do this? For me, the underlying rationale is this. Think about Facebook's existing business model. That existing business model largely focuses on two revenue streams. One revenue stream is advertising, sales of advertising. The other is sales of data. And neither of these two streams of revenue are politically very popular anywhere right now. What does Facebook need? It needs a new way of monetizing interactions across its social media platform. And Libra, particularly the payment system aspect, provides a new way that you can monetize any form of human interaction across Facebook. What's an example of someone else who's done this? Tencent. Tencent starts out as a video game company, expands to a social media platform, creates WeChat Pay, which then allows the monetization of any of those human interactions taking place through their system. So for me, from the standpoint of Facebook, what's really important is that this is the basis of a new business model going forward. Do they actually need a cryptocurrency for this business model? No. Tencent, Alibaba, they don't have cryptocurrencies. They have electronic payment systems that allow monetization of interactions. And that's all Facebook needs. And what have we seen across the last few months? Facebook rolling out Facebook Pay, WhatsApp Pay, Instagram Pay, all of which allow monetization. Real focus in the context of Instagram in terms of retailers. Put a picture of something exciting on Instagram, add in Instagram Pay, someone says, wow, that's cool, bam, I bought it. Facebook has a revenue stream that previously they didn't have. That is what, in my view, it's all about. But from the standpoint of central banks around the world, this has fundamentally changed the way that they look at things. So the framework that we suggest is the real challenges are around who is applying technology, speed of development, leading to things being able to move from too small to care, to too large to ignore, to too big to fail in record time. Libra would be the ultimate example of this. In India, where Facebook is waiting for regulatory approval from the Reserve Bank of India to launch WhatsApp Pay, Facebook and WhatsApp in India have between 350 and 400 million users. As soon as they receive regulatory approval, that becomes effectively the country's largest electronic payment system. Not surprisingly, the Reserve Bank of India has been sitting on that application for almost a year now. What do I think is going to happen? Paytm. Paytm is India's largest electronic payment system. Paytm is somewhere between today 300 and 350 million users. That's incredible, actually, because 3 years ago, Paytm was setting it somewhere between 10 and 15 million users. Today, somewhere between 300 and 350 million users. I think as soon as Paytm gets bigger than WhatsApp, then the Reserve Bank of India approves Facebook Pay, and then you get competition between the two players. But they wait until the domestic player gets bigger. Because had they approved Facebook Pay a year ago, when Paytm was setting at 200 million, the risk of market dominance by WhatsApp Pay would have been too great. This idea of things moving too rapidly.